Welcome to Common Sense Investing. My name is Cameron, and today it's an introductory video to Diagnos Inc. In this video, I'm going to give the bull case to this company, the stock, the bear case to this company, the stock, and then at the end, kind of give my opinion. Which way am I leaning towards? Am I bullish or bearish on Diagnos Inc.? Now, this stock has had a good run to 2023 so far. Can it continue? Let's get started. This is their website, Diagnos Medical Systems. All eyes have a story. We help you read it through artificial intelligence. But before you go, just another penny stock using AI to get a share price bump, listen to what they do, because their single source of revenue, which I really like, is to help detect early vision blindness in diabetic patients and people with hypertension. Right? This is working. This is actually a product slash service that is in eye clinics right now. They say that big data doesn't have to be an enigma. Deep learning can make it simple. Screening services aimed at preventing vision loss and other detrimental consequences of chronic disease. Supporting an active research and development program which encompasses software development, image processing, algorithm development, data mining, and AI. So essentially, when you go to your eye appointment, you can opt in to get this exam through Diagnos Inc., and it can test you for early vision impairment. Have you been screened? You may experience no symptoms until your condition becomes severe. Early detection and treatment can prevent 85 to 95% of blindness cases. We suggest that everyone with diabetes be screened for diabetic retinopathy once a year due to the fact that 347,000 people every year will go blind from a curable disease as they were not screened early enough. They have 16 countries where Diagnos is currently operating in, 131 screening sites, 222,000 patients, which isn't nearly enough. That's why they're a tiny little penny stock. So I don't have a crystal ball with penny stocks, but one of the things that I consistently say on this channel is lots of times I'm looking at an industry I like, and then within that industry, I find a company that I like. With Diagnos Inc., I have to say I like both, right? They're doing something good for people. They actually have a product out there, a service out there. This isn't pre-revenue, right? They're actually trying to scale what they have, and it's something that's incredibly valuable. I like that. I like that industry. I like the fact, as somebody that struggled over the years, wearing glasses, wearing contacts, being devastated back in grade 5 that I had to wear glasses, right? Worried about my eyesight sometimes moving forward. I think this company can provide a valuable source of information to optometrists and hopefully prevent people from going blind. Bonus points. But you always got to think as an investor. If I just invested in every company that I liked, wouldn't make any money, right? You have to be ruthless. So how are they scaling? Right here, Diagnos Retina Analysis is being deployed across Canada's largest specialist care provider in diabetes and endocrinology. So they have contracts. The screening program is being led by Diagnos exclusive Canadian distribution partner, Labtician Ophthalmics. Can you say that? I can't say that properly. Ophthalmics. That's terrible, right? A Canadian-based world-leading provider or manufacturing of medical devices, as well as they're partnering with Coordinated Accessible National CAN Health Network. Now, before I get into the numbers, right, I'm not a financial advisor. I'm definitely not your financial advisor. This is not financial advice. I am one average retail investor that likes to talk about stocks because I believe that having a good discussion about stocks makes us all better investors. This is not how to invest. This is how I invest. So please invest at your own risk. And with penny stocks, it's only your disposable income. Never forget that. So a couple red flags here for me. They've had a wonderful 2023 to their share price after, coming down quite a bit in 2021, 2022. So after a rough couple years, they're starting to recover. In saying that, when the share price was high, the company did sell a lot of shares to basically get some capital. Insiders sold a lot of shares as well, right? So there's a lot of selling going on. 2023, not so much. but be aware that their price to sales currently 83.91 is high. We'll look at their revenue. I'll show you why, but typically I don't like companies with that high of a price to sales. All the numbers that I'm looking at here were released November 28th for their 6-month Q2 of 2023, and everything I'm showing you here is in Canadian dollars. Some problems right off the start, right? Revenue is down, interest expenses up due to some of their loans costing them some more money. Net loss is actually up on less revenue, so nothing good here. Very simple explanations for all this, which I don't mind, right? Sometimes simple is good. Revenue is down because they had a decrease in fees charged for consulting services. Operating expenses are down because they had a decrease in consulting fees related to the company's awareness services. And their interest expense is up due to the increase in debt financing in the form of unsecured convertible debentures. So, very simple 3 sentences here, but explains a lot. Cash and short-term investments is up, but we'll go look at why. Their accounts receivable is down, and their accounts payable and accrued liabilities is up. So again, pretty weak balance sheet so far. Variation in working capital attributable to cash used for operating activities, $1.1 million. So they burnt through that amount of cash, but were funded by right underneath net proceeds from the issuance of convertible debentures, $843,000. So they're paying for their cash through their debentures, and then, of course, their stock warrants, stock options, $447,000 as well. So not great. Here's their stock options. Here's their stock warrants. The company says that considering the closing price of their common shares on the TSX exchange at 53 cents as of September 30th, 2023, the corporation could potentially receive up to $1.3 million from the exercise of stock warrants and stock options. I'm assuming people did convert some of those because they did go up to 53 cents or higher there for a bit, but then, of course, exercising all those warrants and options crashed the share price a little bit, went down to about 38 cents, and now it's trying to recover. Assets over liabilities, nothing too exciting, right? Cash is down, but they do have this short-term investment. Accounts receivable is down, which kind of worries me a little bit. Why that's down if they're growing their revenue right now. Prepaid expenses are up, though, so that's good. Their total assets, because their non-current capital assets went up, their current assets actually went up, but other than that, I thought it's pretty stagnant, right? Accounts payable, though, and accrued liabilities up significantly, which caused current liabilities to be up, right? Total liabilities went from 2.7 million to 3.7 million. So again, just some more weak balance sheet here for me. Revenue, expenses again. The only thing that I wanted to point out, dilution wasn't as bad as I thought. Weighted average number of common shares outstanding went from 69 million to 72 million, basically in about a year. So that's what they've been diluting. And if you look at the dilution a little further, right, stock-based compensation expense went up a little bit, but nothing too crazy. At the end of the day, though, after 1 year, their net loss did increase a little bit, $1.5 million in the 6-month period. So again, where are they getting cash to operate and scale? Their convertible debentures went from 1.6 million to 2.4 million, an increase of $865,000 at an annual rate of 10%, and that's going to mature May 18, 2025. So not too far away. Pretty good deadline for this company to really start succeeding here. And for the next 6 months, they just closed a private placement December 4th, so extremely recently, for $640,000, 1.8 million units at a price of 35 cents per unit. Okay, that's enough numbers to give you an idea. I told you what this company does, what I'm excited about, their product, their service, helping people prevent vision impairment, vision loss, right? That's important. I've shown you the numbers, and I've used the word weak quite a bit, right? The struggling numbers so far that I've seen. What to me right now is the bull case? Why would I want to invest in this stock right now? Well, number one, they seem to have a strong supportive shareholder base. I think looking at the product and service that they offer, they have a lot of big money involved with this company that really wants them to succeed. They've had a really good 2023. That little pink arrow is the last time they did financing, crashed the share price a little bit. They just announced the financing here on December 4th. I'm recording this on December 6th, and share price is still going up. So this time their financing didn't even hit the share price even a little bit, right? People are still buying up this stock. It has buying pressure. And very important for me is I'm getting sick of looking at all these penny stocks, microcap stocks, where people are absolute fans of the company, but it's a pre-revenue, pre-product. Like, if for a small microcap to succeed, typically you need to know if there's a product market fit, right? You need to see some revenue, you need to see some numbers, you need to see some margins, you need to see if people want what they're offering. If you don't have that, your risk goes through the roof. If you're talking about pre-revenue, pre-product market fit company, too much risk for me. I don't really support a lot of pre-revenue stocks on this channel. Diagnosis Inc. isn't pre-revenue. It's extremely early, but they have this partnership here with Can. They're working with Labtician. They are getting their product out there. It's just right now it's not out there enough to really bring in any revenues, right? The revenues are trickling up, going down, going sideways. This company needs something big to scale it because, again, probably around 2025, it's going to have to start paying more and more of this debt interest down. It's probably going to need some more private placements or some more debt in the future to keep going until 2025. So we need to see them scale and continue to do a good job in that. But at least they're not pre-revenue. This is a product, a service that I like, and that carries a lot of weight. Now, what's the bear case? I mean, I don't think I need to talk about it too much here. I've kind of went through it all. Basically, all of their numbers are really tough. Like, I understand this is a small penny stock, right? The smaller the stock, the harder it is to really look critically at the numbers. Lumpy revenue, lumpy expenses, everything's lumpy. I can't tell which direction just about anything is going in here, right? But none of it's going in a good direction. There's definitely a lot of risk here with their financials. So where do I land on Diagnosis Inc? Am I bullish or am I bearish? Believe it or not, I'm mildly bullish. I actually don't mind this stock. And look, let's be real here. Going on my watch list, right? Going on my B list of stocks, going on that list that says, hey, I'm going to keep my eye on this one. But I think the Diagnosis Inc. is good enough for me to keep my eye on because their financials right now aren't great, right? Out of 0 to 5 star that I normally do on like earnings for a lot of the stocks that I cover, probably I give them a 1.5 out of 5, maybe a 1 star out of 5. They have a lot of financial issues. Probably the one that I can, get over the easiest is they're not burning through a lot of money. They're not having a huge net loss. So, they don't need a ton of cash. It's not like they're burning $10 million a quarter, but that's not saying a lot. Their financials are struggling. However, their product, their service, which they have out there right now, screening for vision impairment, if that can go into every optometrist department in Canada, in North America, which I think has potential to do, right? This seems like a pretty standard screening. I don't see why just about every optometrist clinic in North America wouldn't want this. If you have diabetes, if you're suffering from hypertension, which is basically high blood pressure, right? Then, hey, let's give you this test. Now, do not forget, there's like a 45-minute long interview with their CEO. It was just completed with this new podcast show that I've never watched before on YouTube. I will link down below in the pinned comment if you want to continue research. I don't mind you going to another channel. I want everybody to do their own bloody research after this video, right? Let me know what you think. Do you also like Diagnos Inc, or is there just too much risk here? As always, really appreciate your time. Thanks for being here. You've been watching Common Sense Investing. I'll see you again soon.